I'll break it all down and how much more downside we could see, and eventually what turns this market around. Bell Point Chief Strategist David Nelson, Senior Banyan Hill Publishing Research Analyst Ian King, and Fairlead Strategies Founder and Managing Partner Katie Stockton. Katie, I want to start with you. There was already one big rally attempt early. I think it came too early in the session. It's already run out of steam. So obviously the big question is, when will investors know the coast is clear?
I think it's when momentum improves. That's a very easy answer, of course. But what we're seeing right now in the major indices is called a retest. So in October, obviously, a very major pullback across the board. And often those pullbacks, those lows, see a retest as part of a bottoming process. And I think that's what's underway. And yet it doesn't make it feel any better, of course. Sentiment really couldn't be worse. It's very pessimistic out there. And in a way, that could be seen as a contrarian positive as long as the major indices avoid breakdowns.
Well, I mean, so breakdown, in other words, in your mind, would be not holding those October 29 lows, although we should point out on October 29th, the NASDAQ hit 750, and that's already broken down there. The Dow and S&P still above those levels. That's what you're looking for, perhaps, on a closing basis?
There's a number of support levels at play here for the S&P 500. I'm looking at one of my models that shows support around 2640. That's being tested today. All of these support levels need to be viewed as cushions, not precise points. And that's a really important takeaway, where we need to see price below those levels for more than just a day, even in some cases more than just a week, to really confirm a breakdown. So that helps us not panic on days like today when emotions are clearly running very high. There's a lot of gaps down on the individual stock level, sometimes gaps down after these long-term down moves tend to be exhaustive, right. So we have to keep that in mind, too.
Right. Certainly, gentlemen, the idea of capitulation, I think these days we get a rolling capitulation, but today, to Katie's point, was classic, right? I mean, stocks just opened lower and kept going straight down. Ian, for the most part, though, investors ask me the two questions. When does it stop? And when it stops, what should I buy? I mean, do you have an idea of when all of the carnage will stop?
Well, you'd like to see the market close higher on days like today. It doesn't seem
Wouldn't that be amazing?
It doesn't seem like we're getting one of those classic turnaround Tuesdays, Charles. But also to Katie's point, in October, the market got hit with a 8.0 earthquake, and now that you're seeing these aftershock, the tremors, everybody's got itchy trigger fingers.
What was the earthquake? Just the overall sell-off in of itself?
In October, we had the largest monthly sell-off at one point in 10 years. And that's just not October. I'm talking any month in the last 10 years. So it's the first time investors have really experienced volatility in this cycle.
David?
The elephant in the room is still the Federal Reserve. You talked about it at the start of this program. You go back to early October when rates really spiked higher, suddenly saw systematic sellers step out. And that was insurance companies, pension plans who had been forced into the equity markets over the last 10 years, suddenly saw an opportunity to de-risk because they could fund future liabilities with corporate bond paper. And that's something they haven't been able to do for a long time. And when a systematic seller comes out of the woods, they don't care whether they're selling Apple at 220 or 120. They're just hitting the sell button. They're trying to get their exposure down.
Mm-hmm. On the corporate bonds, last week, ETF outflows, we saw high yield stuff, which has been happening a lot, $1.8 billion. Yeah. Mm-hmm. But even investment grade, that's starting to move up the ladder a little bit. Are these yellow flags for you?
That's a real red flag when you see triple B paper, the lower end of investment grade, the credit spreads starting to widen. That actually started overseas. We saw that even in sovereign debt like Italy back at the early part of the year, credit default swaps starting to blow out. So investors, fixed income investors, are moving up the stack. They're moving to higher quality paper.
Katie, I've seen you recently, and I know that you have been somewhat optimistic or bullish going into 2019. Have you changed your opinion or your idea, your thoughts about where this market could go next year?
I'm still very bullish through year end. We had, with that downdraft in October, the most oversold extreme that we'd seen in years. So big decline, big oversold extremes, really in some cases that we hadn't seen since the election low in 2016 and prior to that. So it was such an oversold extreme. We had the market internal measures. Those are things like breadth and leadership and sentiment reach levels that we rarely ever see. And that tees up the market for that seasonal year-end up move.
Well, let's talk about that one second, Katie. Let me jump in because Leadership. You mentioned momentum earlier. I think you meant momentum overall, but it's been the momentum names, the big growth names, whether it's in communication services, consumer discretionary, and of course technology, that have been hammering this market. Can there be new leadership? At one point today, Johnson & Johnson was at a new 52-week high. Coke was at a new 52 high. Hershey's is up. Campbell's Soup is up. Kellogg's is up. We know that these consumer staples have no pricing power, but that's where investors have been heading. And it just reminds us, can anything lead this market higher other than these big momentum names?
Well, I think it's such a top-down oriented move, right, where you're seeing the high beta stocks of the market and the growthier areas of the market underperform. And of course, when we do come out of it, and we will come out of it, they will outperform. They're going to exhibit upside leadership. So I'm still more bullish on tech and discretionary than I would be on staples, in part because they're more offensive than defensive qualities.
In tech earlier today, we did see the chips of all names, start to make really pretty remarkable reversals.
It's valuation.
Is that what it's about?
I think it is. Even looking within chips, you saw on Thursday night, you saw Nvidia have a pretty bad quarter, opens down 20% the next day. Applied Materials, similar, very bad quarter, opens down about 10%, actually ends in the green. The difference was valuation, high free cash flow yield from AMAT, KLA Tencor, and some of the others. And I think the market is kind of telling you where to place your bets. Free cash flow is a place to hide when valuations are. I mean,
Kaluki and Sofa, which is a smaller name, but it's a name I follow for like 30 years, I guess. They had a great earnings report, but they said that the current quarter was weak, relatively weak. They gave guidance that was substantially below Wall Street. The stock opened down at a 2-year low. Then I looked up, and it was up $2. Traded 300% its average daily volume. Something is triggering buyers, and I don't think it's mob-pop buyers. It feels like maybe smart money sniffing around, to David's point, saying, hey, even though the bad news are there areas now where bad news could actually be baked into the cake? Well,
markets classically bottom when bad news gets bought. And so these are constructive signs on the market when you see negative news actually turn into positive market prices. But to your point on the chips, I think one of the overhangs of the chips has been the trade wars, because if the U.S. goes ahead with the tariffs on January 1st, increasing from 10 to 25% on 200 billion of Chinese goods, I think the retaliation is going to come through the chip sector.
So you're not worried then about the chips relationship with Apple and some of these other consumer electronic products being where some of the pressure is coming from?
That's a little bit of concern. You saw Texas Instruments earnings earlier this quarter that announced that slower revenue and earnings growth in the next year. But I still think that more of it has to do with the trade war than anything else.
Katie, let me get your thoughts on some of the issues out there. So we got the Fed. When I listened to third quarter earnings conference calls, I heard strong dollar more than anything else, even trade war. The idea of peak earnings, there's no way we can maintain the 28% year-over-year earnings growth. Everyone accepts that. The trade issues, potentially a war in Washington. The day after the midterms, the Dow was up 600 points, but that went away as we heard Democrats, one after another saying, I'm going to take a committee and I'm going to solely focus on going after President Trump. So instead of legislating, we're talking about investigating. Where do you rank all of the pressures, all the things that are pressuring this market?
Honestly, there's always something from a macro perspective. I'm not a macro strategist, I'm a technician, and really what I care most about is the reaction to these news items and the relief of uncertainty as the news items develop. So that's what's most important to me as a technician. Of course, a lot of these factors that you mentioned are what drive long-term trends, so they're very, very important for investors to understand. What I try to understand is when the market gets overdone on the downside or the upside, and we talked about some individual names just recently, Boeing for one, as having gotten beaten up in the open, and now it may see a better close. And that kind of shakeout type of behavior is really telling. When you get that kind of strong close, that tells you that the market's responding favorably because of its oversold condition, and that's what I look at. As
a technician, I know there's a place everyone looks forward to determine maybe that's the bottom, but do you like to see numbers on the upside taken out? Because no one's going to pick the exact bottom. Have you established numbers already on the upside where you would start to buy or to become more aggressive?
I know we're also hyper-focused on support right now, of course, but in reality, at some point, upside resistance will become relevant. And for the S&P 500, which I watch most closely, The first level of importance is around 2812 to 2817, and that defines this it's called an inverse head and shoulders formation. So it's an intermediate term reversal pattern that would be completed above that level, and that would be a very bullish intermediate term development if you could see the S&P 500 exceed that level. Over the long term, a previous breakout yielded a target for the S&P 500 of about 3,300. Of course, if the loss of momentum that we saw in October sticks this month and into early next month, I think we may have issue with that.
I love reverse head and shoulders, one of my favorite chart formations, so I'm with you on that one. Ian, okay. So I think the rally started too early to bounce. They're selling into it. But where do you start to say, okay, it's okay to start nibbling? People who are watching, when do you start to nibble?
I think you want to look at the February lows in the market. So when we had that brief period of excessive volatility early this year, when everyone was worried about the vol hedge funds blowing up, about 2520 on the S&P. So we could look for a little bit about 5% more downside here before we start to see signs of a bottom.
I can't tell you where the downside is, but I can tell you some key names were just mentioned. Boeing, high free cash flow yield. Investors, that's a good reason why this stock is not trading where it was.
Boeing was responsible for 290 of the Dow loss points yesterday. It was responsible for about 150 at its lows today after they canceled that press conference. They're going to have to address that 737 MAX 8 issue.
It's an important issue.
But once they do, I believe this stock takes off like a rocket. David, Ian, Katie, thank you all very much. Well, we're heading into the final hour of trading, tech, trade, a whole bunch of things dragging on this market. Dow at its lowest point, that was off almost 600 points. That was the session low. The S&P, by the way, now in correction territory. Bringing back Ian King and Robert Luna. So a lot of opinions out there, Robert, and a lot of skittishness as well. One thing I don't see necessarily, though, is the kind of panic that you might have seen in this sort of a sell-off in the past. In fact, most people are asking me, what should they be buying in the carnage? Have investors in your mind gotten too cocky or too confident about the market coming back? Buy the dip has worked for about a decade.
Yeah, you know, Charles, I think they've gotten hardened, right? I mean, we've seen so many of these big corrections, and coming off, you know, the massive decline, obviously, of the Great Recession of 2008 and 2009, I think investors, I know our investors at our firm, are starting to get a little bit more used to this. And, you know, I heard the other technicians talking earlier to say maybe we have another 7 or 8%. You know, I've been doing this for 20 years. If you're trying to predict now how to get out, catch that next 7 or 8%, then you get yourself back in. That's an impossible task, Charles. So I think for most investors, that's a dangerous game. But, you know, the idea about capitulation, I agree. We'd like to see that. Doesn't always happen that way. But in a holiday-shortened weekend, I think it's going to be very hard for us to get that type of volume to pick up off a day like today where you're down 546 points on the Dow.
You know, Ian, also I think people need to be very careful, particularly when they're watching TV. You know, if you're someone who's investing in the market and you're a 40-year-old couple investing, you know, for retirement, or they've got twins, 10-year-old twins at home, they don't necessarily want to take the advice of a trader who's going to be flat at the close anyway, right? So speaking to those sort of investors, what do you say to them in this sort of environment where they're long-term, they don't want to lose a lot, obviously, but, you know, should they be looking now, forming a list, trying to decide at some point, will they put their next tranche of cash?
I think we're seeing a big adjustment in narratives, right? For the last 10 years, you had the narrative called TINA. There is no alternative to stocks. With interest rates at 0%, you had to put your money in stocks. You had to put your money in dividend-yielding stocks. For the first time in September, you saw the Fed funds rate at 2.25%, which is higher than the rate of inflation. Now, this is a game changer because you can actually get a higher yield on cash than you can inflation for the first time in 10 years. And I think the market is really adjusting to this new narrative or this new normal.
Will that, as this adjustment phase, then, will that create new leadership? Again, you know, some of the early bounces, we saw Amazon bounce early, we saw Facebook bounce, we saw the semis bounce. So investors maybe instinctively going for some of the oversold names there. Facebook, of course, down 22% for the year, and the semis getting crushed.
Well, the growth in the market is going to happen from those same tech stocks you just mentioned, the FANG, obviously. And I also think that if we do see some type of Santa Claus rally materializing in the next month or so, it's going to be led by the FANG reindeer, the so-called Facebook, Amazon, Apple, Netflix, and Googles of the world. So I think those are the kind of companies that after you've seen 20%, some cases 40 to 50% pullbacks in Netflix, I'm looking at these names a lot more constructively than I was just a few months ago.
Robert, we've got a minute left. What are you looking at? Have you bought anything today or this week?
Yeah, I mean, we're dipping our toe back into the water into some of the positions we took profits on earlier in the year at names like Amazon, names like Salesforce. You know, Salesforce is a great example of a company that's going to be growing 25, 30% top line. We're worried about all these trade issues. Salesforce is still a company where 75% of its revenue is coming from domestic sources. So, you know, like your guest just said, when this market does rebound, and it always does, it's not going to be the consumer staples. Right. It's not going to be the utilities that are going to lead it. You need growth to take the lead.
So Campbell's Soups will not replace Amazon. Check. I got it, guys. Thank you both very much, Ian and Robert.